Well, hello everybody. It's Ken Himmler, and welcome back. And we're going to talk about the 5 ways that you can actually eliminate capital gains. Yes, there are some ways to eliminate this. And what we're going to talk about today is really 5 separate ways in 5 separate parts. So before we get started today, as part one, I'm going to give you some of the basics as well as giving you part one as to how to eliminate your capital gains tax. Now, make sure that you subscribe because when I come out with part two, then you'll be notified. So make sure you click on that little bell to notify it. So without further ado, let's get this rocking and rolling. So what you're going to learn today, number one is how to time capital gains to completely eliminate capital gains tax under the 0% option. In part two, we're going to cover using paper losses and resetting basis. It's called basis laddering. And three is we're going to talk in part three, we're going to talk about using pure loss harvesting. In part four, we're going to use 664 trust to eliminate capital gains on real estate, a sale of a business, capital assets. It could be even gold, it could be silver if it is in stock or ETF format. And then five is we're going to talk about how to protect against the upcoming and growth on those assets. So before we get into the actual avenues, I think some people have asked me, and I get these emails, and so I want to answer this up front before we get too in depth. And what is capital gains, and how do I actually reduce it? So let's just talk about some of the basics. And how do you compute capital gains tax? I know some people are going, "Oh gosh, Ken, just give me the answer because this stuff is brutal." So absolutely, I will give you the answer. Just bear with me. So for those of you that don't understand capital gains tax, every asset that you buy for an investment purpose has something called a basis. A basis is what you paid plus improvements. It could be, especially if it's on real estate. It's stock, it's what you paid for it plus any commissions that you included to buy that stock. So real estate is cost plus buying costs that you weren't able to write off in the first year, which are most of them, and plus improvement, but not to include repairs. When it comes to losses, here's how you have to figure out net gain or net loss. Your basis, which is what you paid for the stock. And here's a little thing a lot of people miss out on. Don't always assume that the basis is what you just paid for the stock or mutual fund or whatever the asset is. If you're dividend reinvesting, you're paying taxes on those dividends every single year. Those get added to the basis. Now, depending upon the custodian that you might hold that with, but if you're holding certain assets on your own, then you want to make sure that you are counting those dividends that get reinvested. When you talk about a loss on a stock, it's pretty simple. It's either short term or it's long term. Short term is under 1 year, long term is over 1 year, 1 year and 1 day, right? So, how you figure out what your capital gains are at the end of the year is you net out all your shorts, your short term, positive and negatives, you net out all your long terms, and then if you are at a net loss, then you can write off those losses. If you're at a net gain, depending upon whether it's short-term or long-term gain, you're going to pay a different tax rate. And again, if you are at a net loss, so here's a big mistake people make when looking at capital gains and going, yeah, but why should I do that? All I can write off is $3,000 a year. Actually, not true. And I'll tell you a real quick story. Probably, oh my gosh, 20 years ago now. Because as you know, we run a mass affluent family office, which means we hire CPAs, lawyers, financial planners, insurance agents, business consultants, etc., all under one roof. So 20 years ago, I hire a new CPA. Usually what I do is I'll give new CPAs some of my stuff. I'll test them out on my stuff to make sure that they're competent before I give them client stuff. So I give this new CPA my stuff, and he knocks on the door and he says, Ken, I got a thing I want to cover with you. I said, sure. He goes, you manage people's money, right? I said, yeah. He says, something's wrong. I said, what do you mean? He says, well, you are showing over a $450,000 loss. I said, okay. And he said, did you really lose the money? And I said, absolutely not. These are paper transactions to create paper losses to carry forward. A year later, and there was about close to $500,000 in paper losses. About a year later, I sold an office building. That office building had a little bit better than a $400,000 gain on it. So then same CPA walks back and he goes, oh, I got it. I see what you did. You create the paper losses and you let them carry forward until you might need them for any other capital asset. Now here's the key. When you die, you'll lose all of that carry forward. It doesn't carry over to your heirs, unfortunately, because there is this thing called a stepped up basis that your heirs get capital assets for free, so you lose the capital gain loss forward. So in future, in the next couple sessions, in the next couple episodes or parts, I'm going to talk about how to ladder up your basis laddering, so that you don't push too much forward. Okay, so before we get too far into this, if you have short-term gains, it's going to be a nightmare. You're going to get killed with taxes if it's because it's ordinary income tax, which is the highest. If you have held it for at least 1 year, 1 day, then it's long-term capital gains. Now, depending upon how much you earn and you carry those losses forward, you could take that $3,000 loss per year. So most people think, oh, if I sell something, I take a $50,000 loss, I'm only able to write off $3,000. No, you write off the $3,000, you carry forward the $47,000 each year, and you can keep carrying that forward until you use it up. Now, we're going to talk about how you can actually calculate those losses. Let's the income. So we're going to take your Social Security, and we're going to use an example here. Okay, so if you are on Social Security and you are over a certain limit, you're going to pay income taxes on that Social Security. So let's just give you an example here. So let's say that your income exceeds $25,000 or $32,000 married, filing jointly. You're going to pay tax on 85% of your Social Security. And when you take money out of an IRA, it's going to be 100% tax. I know we're going to leave out those before tax IRA contributions because there's a ratio there. And then stock sales. Then you got to add in stock, long-term gains or short-term gains. And again, I'm going to give you this as an example. Of course, dividends are going to be there. So in short, you're going to just add up all your income. You're going to subtract out your deductions. Your deductions are either going to be standard deduction or it's going to be itemized deduction, whichever is higher, right? So itemized deductions would be things like medical expenses that exceed 7.5% of your gross adjusted income. It could be property tax. It could be mortgage interest, as long as your mortgage is not more than $750,000, unless you took the mortgage prior to 2017. But it's those types of expenses, contributions, charitable contributions, etc. Okay, after you calculate your gross income, subtract your deductions, come up with your taxable income. Okay, now here's where the capital gains 0% rate comes into play. What you see is the rates in the tax manuals or online, which you can go anywhere, and you can see that your capital gains tax rate is 0% up to $48,000. Now, in the tax year we're talking about here. If you're married filing jointly, capital gains taxes are 0 up to $96,000 and head of household $64,000. Now, if you have income between $48,000 and $533,000, you're in a 15% tax rate. Single. Married filing jointly, 96 to 600, had a household 64 to 566, 20% rate on capital gains tax. If you're over 533 single, 600 married filing jointly, 566 head of household. Okay, here's how we're going to time this thing. And I'm going to give you an example of this, and everybody's example is different. That's what makes my job so much fun. It's like a different puzzle every single time. It is never the same Groundhog Day. All right, so here we're going to use an example of a person age 62. And what we're going to do is we're going to use a $500,000 portfolio with a $50,000 capital gain. Now, let's also assume that there's $36,000 in Social Security. Now, not many people can live on $36,000 of Social Security. So in this particular case, let's say that there's a separate IRA, 401k, pension plan. We're just going to say IRA for now. And let's say that there's $75,000 a year taken out of that IRA. So if you add it up, yeah, you got about $100,000 a year in income to live on. Without taking the capital gains, the annual tax bill is going to be $13,000. Now let's go through the actual calculations themselves. So first, if we look at the long-term capital gains, if we sold that, we have $50,000. Taxable IRA distributions, $75,000. If you go down to Social Security benefits, you'll see that there's $35,000 there. But here's the catch. Look at that $35,000. You can see that $29,000 is actually taxable because of the way that the distribution is being made. So let's look at it again. We're going to take the standard deduction, 29,000, married, filing jointly, and we have taxable income of 125. So the total tax before the credits is $13,000. Now, if I'm going to do a couple things to get rid of this tax. Number one, I'm going to stop the distributions from the IRA. Why? Because they're fully taxable and they're going to make the tax on the capital gains trigger. So we're going to take the $75,000. We're going to stop that in year one. Number two is we're going to sell the stock. We're going to realize the capital gains. We're going to take that $50,000. Doesn't mean that you have to take it out and spend it. That'd probably be a bad idea, because if you're reinvesting for high growth, I'm just saying sell it. You can rebuy the same investment. You're just going to book that gain. Okay. Number three is you're going to take the $75,000 tax-free from the sold assets. Now you can do it one of two different ways. You can take it from that asset, the $550,000, or you can reinvest it. The goal is making sure that you are not taking money from the IRA in the year that you actually sell that capital asset. Now, what I was saying before is, let's say that you didn't take the $75,000 from the IRA, right? That eliminates the taxable income, but you need $100,000. So just take the same $75,000 and what you were going to rebuy in the non-qualified, the non-IRA, you're going to buy the same thing in the IRA. So at the end of the day, you still have your $100,000 plus of income. At the end of the day, you still have the same exact stock positions that you did before. You're just swapping where you're taking income from and where your positions are held. So you're going to go ahead and buy that same amount in the IRA. Now here's the result. Your income, $75,000, again, from the non-taxable assets, your tax is going to end up being zero. So let me show you how it works. Long-term capital gains, we're going to book the $50,000, right? Social Security is $35,000. Your total income is $75,000, right? But remember, you can still take assets out of the non-IRA to meet the $125,000 that you're used to living on. So here's the adjustments. We have, let's see, $29,000 in standard deduction, and we have $46,000 in total taxable income. But because we removed the tax on the Social Security, we removed taxable income, we were able to fit that capital gains into the 0% tax bracket. So look at what happened. Your income tax is zero. Now, before we jump into part two, again, I want to remind you to subscribe and make sure you get notified, because in part two, we're going to talk about the problem that people have when they continue to let their assets grow and all of a sudden the capital gain gets too big to handle. It's a lot like nutrition, right? If you keep eating bad over a period of time, you keep adding pounds, then it's that much harder to take those pounds off. So we're going to cover how to do what's called basis laddering. And again, don't forget to subscribe, because part two, you'll get notified when it comes out. Thanks for joining.